So the CEO of this company just bought $3 million worth of shares. Hey, welcome back to another video here at FiscalVoyage. My name is Felix. In this video, we're going to talk about Invesco. The CEO just bought $3 million worth of shares. And it's a company that I personally own in my portfolio. I'm actually down in this company. But because of this recent transaction by the CEO and also a director who also spent $100,000 in purchasing more shares, I'm actually going to continue holding this company. But before we get started, if you're new to the channel, there's a free ebook in the description, 5 quick metrics to look for before spending more time in research any companies. Invesco president / CEO buys 3 million in common shares. Here's the post from Seeking Alpha. You can see here, Invesco, ticker symbol IVZ, president and CEO discloses the purchase of 294,507 shares of her transaction value of 3 million. The shares went up, this was after hours, but actually went up like 6-7% that day. And you can see here, here's the actual transaction from the president and CEO of Invesco. You can see here he bought it for $10.19, the total amount of shares, and now he owns 4.4 billion shares of the company. And here's the $3 million he invested, or down $30 or so, or $20, maybe transaction fees and such. But also another note: the next day, on September 2nd, a director spent $100,000 and bought more shares of the company. He increased his ownership by 25%. He bought it slightly higher than the CEO at $10.54 versus the CEO $10.19. Something to consider also: Invesco did cut their dividend by half from $3 or 31 cents to 15 cents or 16 cents, 50% decrease. The forward year at that time was 8.4%. Now the dividend yield is slightly lower than that. Yield right now is about 5.5%, which is still very good. Beats the S&P 500 yield of about 1.5 or so. Let's look at the fast graph for Invesco. As you can see here, the black line is the monthly closing price. The orange is with a multiple of about 9.5, and the blue line is a normal multiple of about 16.5. The green line or dots represents my time I bought shares, so I'm actually down in my position. However, the fact that the CEO and the director spent over 3 million in the company versus my measly $2,000 in this company, I'm pretty confident that the price will most likely go higher from here. Let's look at the time frame here. You can see here where earnings dropped tremendously for 2020, about 39% decrease. Analysts are expecting $1.56 for adjusted earnings compared to the $2.55 for 2019. But you can see here my position when I bought shares weren't actually that bad. I bought it here in the low, and when I bought it, it jumped nicely, but then it came back down, and then I bought more shares because if I buy a company, it's because I like it at this price. So if it went lower, I'm gonna like it even better, right? But then here's the situation happened, with the economy and then the pandemic and such. So it dropped tremendously, and because of this drop, the company cut the dividend. They actually cut it after I bought shares here at 3/12 here, March 12th. I bought 6 shares, so it went lower after that. So from this point, I'm actually pretty up, not that much, but about 13% or 17% with the dividend, which is good. But overall, I'm down with my current position. But as you can see here, analysts are expecting a nice uptick in earnings for 2021 of 7% and 2022 to 6%. So that's positive there. But also consider the analyst scorecard is not that great. 36% miss and 64% hit for the 1 year forward estimates, and the 2 year is slightly the same basically as 36% miss and 64% hit. Another thing I want to look at here is the dividend. You can see here in 2008 the company increased the dividend from 37 to 52, but then it dropped it to 41. I'm not sure if this was a special dividend because that's a big increase and then dropped it, but because if you look, 2007 was 37 cents and 2009 was 41 cents. So from 2007 to 2009 is an increase, but it's a decrease from 2008 to 2009. But I'm not sure if this is a special dividend that they paid out. But obviously they didn't pay out a special dividend here. They actually just cut it. But what I like here is that the company was able still to increase it, in the following years coming out of the financial crisis. So that's positive here. And you can see here, earnings are expected to be higher. So let's look at the free cash flow, because this is ultimately determines the safety of the dividend. But even then, this company has a pretty good free cash flow. As you can see here, it's very well covered, but they still decided to cut the dividend. So this is why dividend history is so important, because even this company, you can see here, had the free cash flow to cover, and even analysts are expecting, $2.42 in free cash flow per share versus the $1.23 that they paid out in 2019. It was very well covered, the dividend, and the free cash flow is expected to be higher, right? So, but they still cut the dividend. But one of the things that's positive again is that the fact that the CEO bought $3 million worth of shares, and the director spent $100,000 worth of shares. So that's very positive. That I'm personally not buying more shares of this company, but I think it's something you guys should look into, because right now it's definitely a great price, very undervalued. And I think the dividends is safe since they just recently cut it. And as you can see here, estimates are expected to be much better than the previous years. It's picking up instead of in the downtrend. And as of today, the stock is up 2%, where the broader market is down 1.23 in the Dow and 1.59% in the S&P 500. So even though the rest of the market is down, this company is up 2%. So that's positive there. So it's something you guys should look into. I'm not going to recommend a buy, hold, or sell. I'm currently just holding my shares. I think it's going to perform much better than the past 2 or 3 years. You can see here the price has been in a downtrend since 2016 or 17. So that's not good, but that's why I bought shares, thinking it was going to go up. But the economic shutdown and such, and the CEO decided, and the board of directors decided to cut the dividend. So right now I'm just holding shares. But if you don't own shares of this company, and looking to invest in a asset under management type of company, this may be one to consider. Because if we project the annual rate of return, you can see here, if the company were to go back to a PE around 12, you have huge total annual rate of return, about 40%. So let's do an adjustment about an 8 PE, which is something more maybe reasonable, because the fact that the company cut its dividend. But even then, at an 8 PE, if it was to expand to that, versus currently at a 5.9, you still have pretty good rate of return. Let's do it here. About 16% annually. Most of it will come from the dividend, as well as the capital appreciation from $11 to around $14. So that's positive there. And something to make you confident in this is that the fact that the CEO and director just put in $3 million and $100,000. So that's very positive there. Boost of confidence, because I was actually planning to sell this once it was about to pick up because of the cut of the dividend. But right now, since these two juggernauts just spent over $3 million into this company, I'm gonna just continue holding my shares. And another thing to note also, the company has good credit rating, a BBB plus, decent long-term debt to cap of 39%, and a great blended adjusted earnings yield of 16.8 or 16.9%. So that's very positive there. Those three metrics. There's one company I would recommend you guys looking into. I'm not providing a buy, hold, or sell recommendation here, but something to consider and look into, because of the fact that the CEO just put in $3 million. So I appreciate you guys. Thank you for watching. And if you enjoy the video, make sure to hit that like button. And if you're new to the channel, make sure to hit that subscribe button. And I'll see you guys in the next one.